Welcome back to the deep dive. Today, we're tackling one of those documents that probably sits on a shelf somewhere for a lot of business
Oh,
owners.
absolutely. Gathering dust.
But it might just be the single most important contract you have, more than your lease, more than your operating agreement, if you're in business with other people.
I agree with that.
We're talking about business continuity planning, specifically the buy-sell agreement, or BSA. I mean, if you're running a business with partners, the question isn't if an owner will leave.
It's when and how.
And when that exit is forced by something like death, the stakes become, well, existential for the business. Our mission today is to unpack how these BSAs secure the company's future, how they protect the owner's family, and crucially, how they're funded.
Which almost always means life insurance.
Okay, let's unpack this.
It's almost impossible to overstate how necessary this is for you if you're a business owner.
Right.
Because without a BSA, the death of a partner, it introduces chaos instantly. You get liquidity problems, management vacuums, and maybe the worst part.
New owners you never wanted.
Exactly. An incompatible partner. Think about it. A share in a private company. It's not like a stock you trade on the market. It's totally illiquid.
You can't just sell it.
You can't. So if a partner dies, their spouse, their kids, they might inherit these shares.
Yeah.
But maybe they want cash, not a seat at the boardroom table. A BSA solves all of that before it becomes a crisis.
I think that incompatibility point is, frankly, terrifying for a business owner. You've built this thing from scratch with your partner, and then suddenly you're co-owning it with a family member who's grieving or maybe even hostile.
Yes. And the BSA is the contract that prevents that exact catastrophe. So let's look at the basic anatomy. When you draft one of these, you have to specify three critical things.
Okay.
First, who has the obligation to buy the shares? Is it the surviving owners, personally?
Yeah.
Or is it the corporation itself?
Okay, so who's the buyer?
Second, the price. How much? Is it a fixed amount you update every year, or is it a formula based on valuation?
And the third one?
It's the linchpin. How is the purchase going to be funded? Because if the price is $2 million, the buyer needs $2 million in cash right away.
Or the whole thing just falls apart.
That's the core of it. And this protection, it works for three different parties. It protects the business itself, ensures things keep running.
It protects the surviving owners from having to work with a stranger.
And so importantly, it protects the deceased owner's family, their beneficiaries.
By giving them that guaranteed buyer, like you said, the shares are illiquid. Without the BSA, the estate could be stuck with an asset nobody wants.
The BSA guarantees a buyer, and it guarantees a fair price. Certainty in a time of chaos.
And that gets to the mandatory sale part. This seems like the ultimate defense clause.
It is. Here's where it gets really interesting. The BSA says that when that triggering event happens, death, the estate must sell.
It doesn't have a choice.
No choice. It has to sell the shares to the surviving owners or the company, no matter who inherited them in the will.
Yeah.
It forces the transfer. It keeps the ownership clean.
Okay, that makes perfect sense. So let's get into the two main ways you can structure this inside a corporation, because that seems to change everything.
It does. It dictates who owns the insurance, who gets the money, all of it.
So structure number one, the cross-purchase agreement.
This is the most direct one. The surviving owners themselves agree to personally buy the deceased owner's shares.
Let's use an example to make the math clear.
Okay. Let's imagine Bob, Calvin, and Dylan. They own a paper recycling business.
Bob, Calvin, and Dylan, got it.
They each own 100 shares. So 300 total shares in the company, a third, a third, a third.
Okay.
Now Bob dies. Under the cross-purchase agreement, Calvin and Dylan are personally on the hook to buy his 100 shares from his estate.
So if each share is worth, say, $10,000, Bob's estate gets $1 million, Calvin pays $500,000, Dylan pays $500,000.
Exactly. And the result is the company still has 300 shares outstanding. But now Calvin and Dylan each own 150 of them.
They go from 33.33% owners to 50% owners. So the pie is the same size, but their slices just got bigger.
Perfect analogy.
Yeah.
Now compare that to structure number 2, the share redemption plan.
Redemption, okay.
This is where the corporation itself buys back and cancels the shares from the deceased.
The effect on the shares must be different here.
It's completely different. Let's take another company, Forest Air, owned by Emily, Fatima, and Gloria. Same setup. 100 shares each, 300 total.
Okay.
Emily dies. This time, the company pays her estate that $1 million. And then it takes her 100 shares and just cancels them. They vanish.
So the total number of shares drops.
It drops from 300 down to 200.
Yeah.
Fatima and Gloria still have their original 100 shares each, but that 100 shares now represents 50% of the company.
So they get the same result, 50% ownership, but through a different mechanical process.
Exactly. Cross-purchase, same number of shares, bigger percentage. Redemption, fewer total shares, bigger percentage.
That brings us to funding, because none of this works without the cash.
It's just a piece of paper without the funding, a wish list. And life insurance, it's just the most secure way to do it. It provides tax-free cash at the exact moment you need it.
So let's link the funding to the structure. The method that perfectly matches that first one, the cross-purchase agreement, is called crisscross insurance.
Right. Individual ownership. Each partner buys a life insurance policy on the other partners.
So partner A buys a policy on B, and B buys one on A.
Exactly. A dies, the insurance company pays the death benefit to B, tax-free. And B uses that exact cash to buy the shares from A's estate. It's very clean.
Is there a tax catch?
Well, the premiums you pay are generally not tax deductible. The government sees it as funding a capital purchase, not a regular business expense.
Okay, but here's where, in my experience, the whole plan can get really tense.
Oh, yeah.
Let's go back to Bob and Dylan. They're equal partners, but they are not equal from an insurance perspective.
Not at all. Bob is 32, excellent health. Dylan is 54, maybe a smoker, has hypertension.
So when Bob goes to buy a policy on Dylan's life, the insurance company is going to charge him a fortune.
A fortune. Because Dylan's risk is so much higher. Meanwhile, Dylan pays pennies for the policy on young, healthy Bob.
And I can just see Bob in that meeting looking at the invoices and thinking, wait a minute, I'm paying way more, but the payout we'd each get is exactly the same. It feels unfair.
It does. And Dylan would probably argue, well, it is fair because you're much more likely to collect on my policy first. And he's probably not wrong. But that exposes the core friction of crisscross funding, that premium inequity.
What about taxes for the person who died for their estate?
Good question. So the law deems the deceased to have sold their shares for fair market value right before death.
Which triggers a capital gain.
It does.
Yeah.
A potentially big one. But for you, the listener, if those are qualified small business corporation shares, there's a huge tool available.
The lifetime capital gains exemption, the LCGE.
That's the one. It's a massive deduction. It was over $1 million in 2024 that can shelter most or even all of that capital gain from tax.
So it seems like a win-win, except for that whole premium argument.
Right. And that's a perfect segue into the other way to fund this. Business-owned insurance.
So the corporation owns the policy, pays the premiums, and is the beneficiary.
And that immediately solves the Bob and Dylan problem. The company pays, so the cost is shared equally by the business. The individual health and age issues they disappear from the equation.
And it must be simpler from an admin perspective too, right? If you have 4 or 5 owners, managing a web of crisscross policies sounds like a nightmare.
It's a huge headache. It's much cleaner for the business to just own all the policies.
Yeah.
And you can always check the company's financial statements to make sure the premiums are actually being paid.
There's a tax efficiency argument here too, I'm guessing.
There is. Premiums are paid with after-tax money either way. But if the corporation's tax rate is lower than the partner's personal rates, which it often is, it's just cheaper for the corporation to foot the bill.
Okay, so the company gets the insurance payout, $1 million, let's say. But that money has to get to the deceased partner's estate somehow. If the company just pays it out as a normal dividend...
It's taxable, a huge tax bill. It would completely defeat the purpose of the tax-free insurance benefit.
So there must be a special mechanism.
There is. And it's called the Capital Dividend Account, or CDA.
The CDA. This is so important. It's not a real bank account, right?
Correct. It's a notional account. Think of it like a ledger, a tracker on the company's books. It tracks tax-free amounts the corporation receives, like that life insurance death benefit.
So the $1 million payout from the insurer gets credited to the CDA.
Exactly. And here's the magic. The corporation can then choose to pay that amount out to its shareholders as a tax-free capital dividend. The money flows out to the shareholder or the estate, and no one pays any income tax on it.
And just to be precise, we're mostly talking about term insurance here, where the policy's cost base, its ACB, is 0.
Right. If you use a permanent policy like whole life, a small portion related to that ACB can be taxable. It shows you how detailed this can get.
For sure. So let's bring it all together. Let's see how this corporate funding works with the 2 structures. We'll use Jackal Inc. with partners Jack and Alfred.
Okay, let's follow the cash through the CDA.
Let's start with the more complex one, Corporate-owned insurance funding across purchase. So Alfred still personally has to buy Jack's shares.
That's the key. The obligation is personal, but the cash is corporate. So we need to connect them. It takes about 7 steps.
Yep.
First few are easy. Jackal Inc. pays the premiums, Jack dies. The insurance pays the tax-free benefit to Jackal Inc., and that creates the balance in the CDA.
Now, how do we get the cash to Alfred?
Here's the clever part. Alfred goes to Jack's estate and buys the shares using a short-term IOU, a promissory note.
So he's basically in debt to the estate for a moment.
For a moment, yes. The shares legally transfer to him. He's now the 100% owner.
And now he has to pay off that IOU.
Right. So he immediately instructs Jackal Inc., which he now fully controls, to pay him a tax-free capital dividend out of that CDA balance.
Ah, and he uses that tax-free cash to pay off the promissory note.
And the loop is closed. It's a beautiful piece of financial choreography to move the corporate cash to the individual buyer, completely tax-free.
That is sophisticated. Now let's compare that to the simpler route. Corporate-owned funding of a share redemption plan.
Much, much simpler. Because here, the corporation is the buyer. The cash doesn't need to move to Alfred.
So what are the steps?
Just 5. Jackal Inc. pays premiums. Jack dies. The insurance benefit goes into the company's CDA.
Okay.
And then Jackal Inc. just uses those funds directly to buy back or redeem the shares from Jack's estate. It cancels them. Alfred still owns his original shares, but now he's the 100% owner. The cash never leaves the corporate level.
Wow. Okay, so connecting this all to the big picture, the choice between all these options, cross-purchase versus redemption, crisscross versus corporate funding, it really depends on the business.
Completely. The number of owners, their ages, the company's tax situation. This is not a do-it-yourself project. It's sophisticated financial engineering.
You're tying together ownership structure, tax law with the LCGE and CDA, and insurance mechanics.
Absolutely.
So what does this all mean for you, the business owner? It means that if you try to take a shortcut on this or just guess on the funding, you can create a massive, unexpected tax bill.
Or the whole buyout could fail,
Yeah.
forcing a liquidation of the business.
You have to talk to a tax or estate planning specialist.
The technical details are complex, yes, but the human consequences of getting it wrong are just massive.
I think the ultimate question for any business with multiple owners isn't about the acronyms. It's much simpler than that. It's this. If your partner died tomorrow, are you absolutely confident you could buy their share seamlessly, legally, and without having to sell off critical assets or take on crippling debt? That confidence is the return on investment you get from a properly funded buy-sell agreement. And if that confidence isn't there, your business is resting on a very, very shaky foundation.